Thank you to Hamilton ETFs for sponsoring this video. What is up, you guys, and welcome back to the channel. Our good friends over at Hamilton ETFs just launched an ETF that I think is particularly timely given the current state of the market. I think there's a very compelling story to be told here about how an ETF like this performs during volatile markets, not only during volatile markets, but particularly during volatile markets. Today, let's dive into the brand new ETF, ticker MIX, the Hamilton Enhanced Mixed Asset ETF. This is what they are coining as a better all-in-one ETF. Now, what I first want to talk about and what I very much like about this ETF is that it is a very, very simple concept to understand. It's a 3-fund portfolio, providing 60% exposure to US stocks or US equities, 20% exposure to US Treasuries, so bonds/fixed income, and then 20% exposure to gold. This fund then applies the typical modest 25% leverage that you may be used to from Hamilton. And the key to point out here, it tracks an index that after the modest 25% leverage has historically outperformed the S&P 500 with lower volatility. We have tons of data to dive in today, which I'm very excited to share with you guys. But essentially, what Hamilton has done here is taken a spin on the traditional 60-40 asset balance, one of the most popular balances amongst so many investors for as long as we can go back. You're getting exposure to the core investing assets in equities and fixed income, but you're also adding gold into the mix, which I may add has had an awesome performance year to date, up 23% at the time of filming. Logically, given that the markets have kind of been in shambles, especially as of April, but for certain parts of this year. And the high level strategy really behind this mix today is you're getting diversification between your key asset classes. Number 2, by adding an element of gold into the mix, the way that these 3 assets perform in relation to each other, we could look at correlation or actually lack thereof in this case. This ETF sets out to provide lower volatility, lower drawdowns, but still managing growth-like returns that you'd expect if you were purely an S&P 500 investor. And I want to dive into the data here because we got some very fascinating stuff to look at in this video. Because this is a new fund, we'll of course be looking at the index that this ETF tracks. And what we notice is that dating back 20 years, even the non-levered version has managed to perform right in line with the S&P. Now, if you take the enhanced version, which we see here in this darker brown line, we see the 12.4% average return versus the S&P 500's 10. Now, if you're anything like me, your first thought may be leaning you towards, well, how does an index that is only comprised of 60% stocks, right? 60% allocation to US equities, how can that be providing performance in line with just 100% S&P 500 index? Well, what we see, and this is really where the magic is happening, due to the correlation, or I should say lack thereof, between these asset classes and the lower exposure to equities, this index experiences lower drawdowns and less volatility, meaning that the index/portfolio doesn't drop as much during the rocky times that we see in the market. They have less ground to make up when it comes to recoveries, leading to faster recoveries. And we take here the standard deviation of the S&P at 19 compared to half of that for the unlevered version. And even if we were to look at the levered index, we still see a significantly lower standard deviation to prove that point. If we look at the drawdowns, where an all equity S&P 500 index may drop 55%, while a mixed asset index sees essentially half the decline. And even here with the levered version, a 32% drawdown or drop versus the 55. And we've talked about this math on the channel before, but a very common misconception amongst investors is understanding how much of a gain investors need to experience to wipe out an equal amount of loss. AKA, a 50% drop in your portfolio does not get negated by a 50% gain. You actually need to make double that in order to get back to essentially where you started. You can understand why investors that prioritize more of a balance within their portfolio and focusing on minimizing those drawdowns can be a very, very impactful strategy long term. In fact, here's a graphic that really does a great job of emphasizing this point. I will, of course, include all of these down below for you to take a deeper look at. But what you are looking at on the screen is the top 10 equity drawdowns that we've seen over the previous 50 years. The one caveat being this one here, highlighted the Trump tariffs, which are of course ongoing. But what we see is the data on how different assets or different asset classes performed during these periods. And let's just look at a couple as an example. We'll take the financial crisis where equities lost 55%, while treasuries posted a gain, an increase of 21%, gold increasing 65%, and this column here shows how a 60-20-20 allocation, so if your portfolio had this balance or mix, would have performed or held up during this period. Well, we see this would have only dropped 25% versus, of course, the 100% exposure to equities down over 50%. And here we have the drawdown multiple of 0.45, also important to gauge how much less the portfolio would have dropped in this given circumstance or scenario. Now, the dot-com bubble, we can take a look at that back in the 2000s, same story. A 50% drawdown multiple where assets like treasuries and gold held up very well. COVID, a 0.53% drawdown multiple, and so on and so forth. In fact, here on the screen what you're looking at is the top 50 occurrences. If you want some more data to look at, some more justification, please feel free to pause the screen or visit their website because we're not going to go through all of these. But essentially the moral of the story here that I want to share with you guys in this video is that the fund mix in and of itself, it's a very simple concept to understand. It's a 3-fund portfolio. It consists of the Vanguard S&P 500 fund, the BMO Gold Bullion fund to get the gold exposure, and a Vanguard Treasury ETF. And as the back-tested data suggests, you can experience the equity-like returns with a much smoother investing process or smoother journey along the way. At the end of the day, whether you are young or old, the index that Mix is tracking here has been keeping up and in fact outpacing the S&P 500. The way I see it is this is a fund meant to be a long-term core growth solution. It's essentially an all-weather portfolio designed to be part of that long-term buy and hold strategy that can do a great job of weathering the storms. To be very clear, this ETF mix is not the typical income-related product that you may be used to from Hamilton in the past. In fact, the yield on this I'm sure is quite nominal, given that it's essentially investing in the S&P, some gold, and then some treasuries. What you do get, however, is what is expected when you invest in a Hamilton product, such as in this case, it being a one fund, one-stop solution. You get the hedging, of course, done for you. You benefit from institutional pricing on the leverage, and this fund in particular exhibits constant rebalancing, actually at a plus or minus 2% drift from the target allocations, so you don't have to worry about any of the active management yourself. And lastly, if this is a fund that you are interested in, after, of course, doing your own research and due diligence, well, you can enjoy the rebated management fee for 0% through to April 30th, 2026, before moving on to a 0.35% fee. At the end of the day, I personally am a big fan of this fund. I like the simple concept, the simple approach, and the back-tested data. I'm very excited to be sharing it with you guys today. I'm curious to hear your thoughts down in the comment section below. I'll of course be including links down in the description to everything that we covered today so that you can have a look for yourself, do your own research and due diligence. But I want to thank Hamilton once again for sponsoring today's video. As always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next one.